there is a correction going in the market. So what will be your advice to customers at this point of time?
I think it's a much awaited healthy correction. Market has been on a tear for almost 6 years in a row now. So in cricket parlance, we are in the middle overs, if you may call it. We moved from a double-digit inflation country to a mid-single digit, and now we are into a probably heading towards a 4 to 5% low single-digit inflation. Now, so typically when these kind of decaded shifts happen, the attractiveness of debt tends to keep going down.
Which are the sectors you would want to take higher exposure to? Which
Auto components. Second is, and third is, I think, it's like asking which kid of yours is the best suited.
How long the correction can go? Hello everyone, we at Vruksha have been very passionate about spreading financial literacy through sessions at colleges and at corporates. Today, we take a next big step in that direction, bringing the best minds in financial services to share their knowledge to our viewers for them to understand more and increase their knowledge. In our first episode today, we have with us Mr. Bharath, Head Equities of Sundaram Asset Management Company. Bharath has over 2 decades of experience in the industry across equity research and fund management. Bharath joined Sundaram Asset Management Company in August 2004 as a research analyst. He individually and jointly manages Sundaram Midcap Fund, Sundaram Large and Midcap Fund, and he also manages the equity portion of Sundaram Aggressive Hybrid Fund, Sundaram Balanced Advantage Fund, and Sundaram Conservative Hybrid Fund. Welcome, Bharath. Sundaram AMC has gone through a lot of changes, particularly in the top management these days, right? So what kind of changes or developments customers can expect because of these changes?
Great. So thanks for having me on the show today. I think from Sundaram AMC perspective, we've had Mr. Krishna join us as CEO. So he comes from an investment background with more than close to 3 decades of experience in the markets. Really, it adds a lot of strength in terms of investment processes, as well as in terms of strengthening in terms of how we ideate for new products. As you all know, Sundaram is known for bringing unique products to the market at various points of time. And with him coming in, this will get strengthened further. In view of that, we also had our first maiden launch under his leadership. We had the Sundaram Business Cycle launch during the month of June, which is again a unique, dynamic, multi-thematic fund, which not many funds do offer at this point of time. So I think the clear dimension is on the investment side. And apart from that, we also added more hands to our team in terms of fund management. We've added few fund managers to handle the additional set of products that we are launching in at this point of time. So that's where we are in terms of our changes. And I think clearly it would be our endeavor to keep not only bringing in new product, but also strengthening in terms of our consistency in the existing product.
That's very important.
By broadening our own dimensions and, in terms of investment ideation and processes, which is where I think these changes do help.
Great. As we speak, there is a correction going in the market, and it's natural that investors get a bit worried around this time. So what will be your advice to customers at this point of time?
I think it's a much awaited healthy correction. Market has been on a tear for almost 6 years in a row now. And we've hardly had meaningful drawdowns in the market except for certain phases like Ukraine war or a pandemic phase in between. But I think this has been one of the, let's say, a cult move in terms of retail participation, what we've seen in Indian context for the first time. Healthy correction always gives some of these fence sitters to come into the market, given that there's always apprehensions when markets are one-sided. So that's the first context where we think it's a healthy correction in the first place. The underlying correction is something where we think it's more driven by sentiment. From an earnings perspective, markets are still on a very steady wicket at this point of time. So we aren't much worried in terms of medium-term drivers of the market. So in cricket parlance, we are in the middle overs, if you may call it. So from that perspective, these corrections should be looked as or construed as an opportunity for long-term investors who have a 5-year kind of a horizon in the markets to come in and wet their feet with a gradual allocation increase, I would say. And of course, choice of stocks do matter in every marketplace. Good businesses at better price points is always a much better strategy than chasing weaker businesses at higher price points. So we are in a phase where we are probably getting good businesses at better price points with this correction currently underway.
Interesting. So on the investment strategies front, before September, there would be a strategy. Is there a tactical change which Sundaram's funds would take to cope with this kind of a market atmosphere?
I wouldn't say there has been a very drastic change in terms of strategies. So we've been anchoring ourselves to 2 areas. One set of businesses where there is a steady compounding in terms of the basic business, and a set of businesses where the cycle is in play. some of these sectors are cyclical by design, and we are seeing the cycles actually strengthening. At this point of time, we are probably doing some bit of profit taking in some of these cyclical areas where the cycle is kind of priced in to a large extent, but the other part of the set of stocks where it's a steady business, steady ship where the business is still component at a place, we are staying put with that. The second dimension is in terms of how much inward looking we are in terms of domestic versus external export driven businesses. We have a slight inclination to more inward domestic looking businesses where the drivers are more visible, I would say. We are in an uncertain world today. Every economy has its own set of challenges. So we are keeping an eye out on a set of companies where the drivers are domestic driven and where our visibility is much better.
So you mentioned about you booking profits with the overvalued kind of sectors or stocks. So would you really buy immediately? Have you already bought or will you be sitting on cash now?
No, so we as a house, we don't take aggressive cash calls. So at best, it's 5 to 6% at a point of time. We believe in staying invested in good business at a better price point at any point of time. And we do a slice and dice of our positions based on how much a stock is delivered in too quick a time or if there are certain excesses happening. But otherwise, we don't take outright cash calls in the market. In terms of the overvalued sectors, there has been, for example, certain pocket within manufacturing which had a great run in the early part of this year when you also had a lot of product in the market gunning towards that segment. And in those pockets, like for example, in case of segments like railways or defense, we've been more prudent in terms of our exposure rather than having a heavy overweight in those segments where we think some of these longer term growth opportunities got priced in too early at that point of time. And of course, the stocks have kind of course corrected in between post that. So I think those are the areas where we've been kind of more prudent. And second is in terms of export driven sectors, certain areas like chemicals, for example, we've been underweight. It is a cyclical sector which got a tinge of overvaluation when markets extrapolated China's absence for a long period of time. And with China coming back, that sector has got its heat again in terms of competitiveness. So we've been taking profits out in that space from the early part of the year to where we are today.
Yeah.
If I may ask, in terms of investors' response in this phase of correction, what's been your experience?
Interestingly, I would say investors clearly have been depicting that maturity which we wanted them to show. So the earlier corrections, be it the COVID being the deepest of the ones which we saw in the recent past, SIP investors particularly, would want us to really pause it. There were cases where people would want to even withdraw. Unlike those days, today, we hardly even get calls from their side. While we have been communicating to them on what's happening in the market, there is really no concern from their side, particularly on SIP investments, redemption of that. And investors, in fact, who are in the sidelines are showing that courage to deploy at this moment, while we, of course, are asking them to put it in a staggered manner. There is very good encouraging signs from the investor side. It is very high maturity shown by them.
It's a sort of fearless investment.
Absolutely. They have got evolved, the much needed evolution.
And in terms of categories, are they kind of trying to hide safe in a particular cap or it's broadly as similar to what they've been investing with the so far?
There is an interesting and healthy change which we see. While there have been discussions about, small and mid caps getting overvalued and being in an overheated territory, investors are very clear. As long as they know the risk profile is taken care in terms of the asset allocation, they're not wanting the money to be moved out of small and mid cap. The excesses, yes, wherever it is slightly over and above the, risk profiles asset allocation, the excess, they would want to move to large caps. Otherwise, they are not saying to be completely in large caps also. However, there has been some risk mitigation through the balance advantage, multi-asset kind of funds. On the equity per se, fresh inflows, there is interest to get into large cap biased funds. Otherwise, the holdings which are supposed to be in the small and mid cap as per their asset class, they are not really wanting to make any change.
So there's no exodus of one cap to the other cap.
So what will be your advice? In case we expect a little more correction and if investors would want to stay in the sidelines completely, there are some segment of investors, while it may not be our investors, definitely there will be investors who have got into the market in the last 2-3 years who have never seen a correction of this sort. If there is fear, and if these are people who really did not know the risk characteristics of the market and they would want to stay away, to such worried, scared investors, what would be your message?
I think if people still want to experience equities and there is a fear to confront volatility or risk, some of these vehicles like hybrids, for example, could be a better vehicle to navigate these markets. Essentially, what you're targeting as a solution for that customer is that you're trying to give a product where you give a equity experience with a little bit of a lower drawdown when these kind of air pockets come into the market. I think we are in such a phase where today where probably market might have moderate expectations on a very near-term basis. And if investors are worried about drawdowns, these are products which can help mitigate those phases in the market. In our view, I think whether it's balance advantage or whether it is a multi-asset allocation, these are categories which kind of help mitigate equity risk in a very short-term time frame. And that can be a solution for those investors who are probably not seasoned yet for a phase like what we are in today.
So while I mentioned, investors are okay to be going through the rough patch of the small and mid caps, what would be your advice? Moving predominantly to large cap, will it make sense? Or would you ask them to be allocated as per their, asset allocation, where small and mid caps should continue, where it can be a little tilted towards large cap? What would be your advice?
I think it depends on the horizon. If the investor is for the long haul, a typical asset allocation plan should be undisturbed, in my view, personal view, over a period of investment, what they are gunning for. I think so. If it's a 5-year money, typically the cap curves beyond the large caps do still offer incentive to be invested in. To give you some statistics, the mid cap earnings CAGR carries a 6% alpha or differential over the large cap earnings CAGR simply because the size is different, right? So the mid-size and small-size companies have the ability to grow faster if the environment is conducive. So in those phases of growth, the value capture tends to be higher typically. So from that context, if it's a 5-year money coming in, I think sticking to an asset allocation will still make sense. Having said that, if there is a part of the asset allocation where the investor wants to play around with market uncertainty in between, having a slight skew to, say, a large and mid cap category or a large cap category can still contain the overall portfolio volatility. So I would kind of peg it with what is the horizon which the investor is coming in. And large caps and large and mid caps have a much more steadier volatility compared to a little bit of excesses which happen in the smaller end of the market. So if it's about containing volatility, a skew towards large cap or large and mid caps might still be beneficial. But if it's a longer term money, I think asset allocation should be undisturbed. Purchase.
I think with whatever changes came in the taxation for debt funds, most investors, particularly in the last 2-3 years, after the interest rates started rising, have kind of abandoned debt funds, and probably they are only equity or more of equity investors currently. To these investors, while it may get a little prolonged in terms of the interest rate cut coming, would you suggest them to visit back to the debt funds to take advantage of the interest rate cut? Or is it okay for them to be in a hybrid kind of fund, continuing to take that, allocation with the exposure of hybrid funds?
So I am not a debt fund guy, but still I'll try to support my views on this with some analogy. So start of 1990s to early 2000, we as a country, we were a double-digit inflation country. 2010-11, we averaged around 7% to 8%. And then in the last 8 years, we are averaging 5% inflation. So structurally, we moved from a double-digit inflation country to a single digit, and now we are into a probably heading towards a 4 to 5% low single-digit inflation. So typically, when these kind of decaded shifts happen, the attractiveness of debt tends to keep going down because your ability to typically they follow your inflation, and inflation plus a corridor is what your debt instruments earn. So in that context, your ability to price yourself in terms of debt as an instrument gets weaker from a decadal perspective. So that's one reason why a skew to equities is warranted at any point of time. Having said that, debt does serve its purpose in terms of buffering shocks because not everything is rosy in equity at all points of time. So you need a buffer to soak that shock whenever it happens. So from that perspective, a combined offering of a debt with equity in the form of an aggressive hybrid or a BAF or a multi-asset will serve its purpose for people who need that buffer just to kind of keep it as a shock buffer whenever there's a shock or an event happening in a market. We shouldn't forget that the last 4 years, every year had one event or the other. right? Whether it's pandemic 1, pandemic 2, Ukraine war, Israel war, and a US election, whatever be it, it doesn't hurt to have a buffer in case we have those events in the market. So I still think in the long term, equity wins hands down. Given from an Indian perspective, we are seeing this decadal shift in terms of our own supply getting better and inflation getting lower. But for somebody who's wanting a medium term solution, a debt included instrument wouldn't hurt them to be.
Maybe the appreciative view also on the taxation front, this helps because somebody who's in the highest tax bracket, where he will land up at almost 39%, today debt is going to be at that rate. And if he is getting that flavor of debt through a hybrid, you still get it taxed only at 12.5%. So it is less than 1/3 of what you would have otherwise paid as tax in a debt fund. Makes a lot of sense. Yeah. In the current market climate, which are the sectors, which you would want to take higher exposure to? Which are the ones which are looking attractive and for what reason?
Okay. So I think there are two structural tailwinds from our own economy perspective. So big money or consistent alpha is made when you catch a sector EM. And as the sector matures, you have a good probability of catching, winners in that space. So in that perspective, a lot of sectors are opening up in India probably in the last 4 years after the Atmanirbhar got launched and we started building policies anchored to it. So I think some of these new areas where we are becoming large capability hubs to not only service our market but markets outside, we will have opportunities. Like I can name a few, like auto components, for example. Gone are the days where an auto component supplies only to the Indian OEMs. We are now emerging as hubs to service your Teslas of the world or all the German OEMs of the world. I think that is one space where we could have a long haul in terms of opportunity where we are constructive. Over cycles, we've been overweight as a space. Auto components is one. And the second fascinating part of auto components is the customer himself is upgrading his choice. Gone are the days where a small vehicle customer migrates to a MUV and then an SUV. The first customer today is willing to buy an SUV directly. So the content in the car is getting much more richer than what it used to be earlier, which is again an additional lever for an auto component company. So that is one space where we are constructive on. And second is consumer discretionary space, which, just to anecdotally give an example, when I grew up, it used to be probably 2 shopping seasons in a year. Today, my daughter or my family member doesn't wait for a particular festive season to go shopping. It is happening multiple times in a year. So the aspirational buying of a consumer today is far different from the early decade. And that triggers a lot of demand for whether it's a retail chain or an apparel company or a footwear company, whoever be it. So identifying companies which are anchored to this set of customers with the right product is again a winning opportunity in the long term. So consumer discretionary has so many sub-segments where we think we should be overweight on from a structural perspective, because India's working age population will keep moving up for the next 23 years. That is the second area where we are positive on, and these market conditions as well. And third is, I think, because we are large data users, certain areas within industrial companies are geared to this change in the way data is consumed in our country. Data centers will keep moving up in terms of size and shape in India. So companies which supply cooling systems or power backup for these sectors, they are going to have a non-linear growth over a medium-term period. So these are 3 areas which are again inward-looking, domestic focus, where we are constructive on from a market environment perspective. We don't think the undercurrents get disturbed with the correction that we are seeing in today.
So interesting part about, the festival seasons which you are talking about. Now there are the festivals as such where there is a demand created. Now you also have festivals manufactured by the e-commerce portals, which probably sell more than even normal festival season sales, right? So while I say that, when you were talking about auto components, at least this festival season, auto sales was good, but it seems that it was sold with a deep discount, and that's how they were able to sell this. When such deep discounts cannot be sustainable for them, how do you think this can have an advantage on the auto components when this is the case with this kind of sales which happens in auto?
No, you have a valid point, because what happens is always a mismatch between how the OEMs plan for growth versus how the customers kind of walk in at that point of time. Like this year, it was a dichotomy where two-wheelers did extremely well, whereas passenger vehicles had a mid-single digit growth in terms of festive to festive comparison. So from component perspective, today the ecosystem is fairly well set, where there is a pass-through mechanism whenever there is a material price inflation. And the component manufacturer is an essential part of an OEM's design element when it comes to a design of a new platform or a new launch, what they have in their kitty. So the ability to squeeze is a tad lower than what they used to do earlier. The reason why the discounting, in my view, is more prevalent is that material prices today is far more benign compared to what it was, say, during 2022 or 23 when Ukraine issue blow kind of had an impact on that segment. So they're able to pass on their commodity gains to attract the customer. So that is one why you're seeing discounting actually hitting the headlines, but it's not impacting the profitability of the car maker as much. So the component guy today is not squeezed as much as what they used to do earlier. Car makers are using the material price gains to pass it on and attract a customer.
Well explained. I think this was an answer which was in a very interesting and a very rational angle. So this is about the sectors which are looking rosy now. Otherwise, now which are the other ones, which are really overheated, where you think investors, if at all they have got into a sectoral fund of that sort, because there were so many sectoral funds which came in the almost fading out stages. What are those kind of sectors which investors have to exit from, and which are the ones which you already also exited from?
So I think it's a great question because not every great business is a great buy. A market has its own nuances in terms of writing something upfront and it might not be providing any meaningful returns over a long decade because the valuations have captured it upfront. So there have been many pockets which had this phenomenon in the last 2 years. So one which I referred earlier was the chemicals, specialty chemicals as a space. Cyclical growth was extrapolated as structural growth and multiples got priced in upfront in terms of whatever investments the companies are making. And unfortunately, the season in terms of global agrichem was weaker. So this set of companies had a derating in terms of multiples where we've also been underweight in terms of our own exposure. So this is a space still, I think, where a lot of growth is priced in upfront and one might have to wait it out to capture alpha. The second is within manufacturing, certain pockets, like for example, I can name defense as an example, where not every company had the same linearity in terms of growth. So within defense, some of the segments have a long gestation where ordering cycles tend to get delayed. Everything was painted with the same brush. So one needs to now get the speed dirty to understand which one has a much more steadier set of ordering, which one could have a delay. So that's an area where you might have pockets of overvaluation very clearly, and it might have be a back-ended return in terms of investor experience. And third area where we are not so worried on overvaluation, but where growth is getting challenging is within consumption. What is happening in consumption is that the leaders are getting challenged by players from other sectors or segments coming into their segment. So, for example, a building material company is getting into paints, a paint is getting into tiles, a tiles is getting into wood material. So, competitive dynamics in consumer segments is getting different from the last cycle. So, if somebody had looked at consumer space saying structurally, like paints is good and it's here to stay, the competitive intensity has changed in paints compared to what it was, say, in the last cycle. So, we typically worry in case of overvaluation where the dynamics is changing. If it's overvalued but the dynamics is changing very sharply, then it's a clear avoid. If it's overvalued but the earnings is compounding without too much of challenge, we tend to still find a reasonable merit to see whether the company is worth staying invested or not. But the first part is a little bit worrisome where then you're playing for a lower growth environment given the competition is higher, plus the top multiples also is at risk in terms of derating.
Now, in this market climate, there might be investors who have recently ventured into equity fund investing. And if this is going to be a second or third investment of theirs, among your schemes, which are the schemes or which is the one scheme which you think is a good pick for them for a 5-year horizon investment?
Like asking which kid of yours is the best suited. So I'll put it this way. If it's a new investor who's walking in, obviously he needs to have an equity experience, which is fulfilling so that he gets accustomed to the vagaries of the markets. Typically, from an Indian market perspective, one category which has been time tested in our experience has been a mid-cap category, because typically mid-cap companies are those where entrepreneur crosses that initial struggles of entrepreneurship and gets a little bit more professional over a period, and you have a set of companies which are categorized in that bucket as mid-caps. So either a mid-cap or a larger mid-cap category is something where you have a 5-year experience which can be reasonably better compared to staying to the smaller end of the market where you do have the risk of misallocation of capital, or the business itself getting challenged over a period of time. So if the investor is even more risk averse or a little bit conscious about risk, a large and mid cap category is something where you have the best of both worlds. You have 50% exposure to large caps, which are a much more steadier set of vehicles, and you have 50% exposure to companies which are your emerging large caps. So I think that's a category which can be suited for the requirement which you outlined in terms of the investor.
Okay. So now one question which everybody wants answer for: how long the correction can go, and if we have to recoup, and if the consolidation phase has to settle down, which are all the reasons which have to come into play for that to happen?
We look at FY25 from where we stand today to the next 12 months, since it's a short-term view which you're asking for. I think the year where we are keeping our expectations very moderate. There are 2-3 reasons which underpin it. So this is a year where the flows are fantastic in terms of domestic flows, right? But globally, we are seeing a resurgent developed market come, especially in the form of US. The policies of those regions which are coming back strongly, especially the US context, will determine a flight of capital from emerging markets to developed markets, which has already started from an Indian market perspective. You see, the last 1.5 months, we are seeing that happen. We live in a relative world. So when money moves out from our market, we need to take the hit on the chin and move on. So that is one. Second, trade and tariff, when it gets announced as and when the new regime sets up in the US, that has an impact to some sectors which are linked to those markets. So that will have its ramifications when it plays out. From our own market perspective, domestic flows have been fairly resilient. But the flip side of it is that we've never had a very strong IPO pipeline till, say, early August or September. What we are seeing now is a fair amount of issuance pipeline, which will soak up some of this excess or the high liquidity which is there in the market. So I think these are some of the, I would say, sentiment-driven factors which affect the flow of capital between one pocket to the other. On a fundamental basis, we had one of the best years in terms of earnings last year. Aggregate corporate India, if my memory is right, including 1,400 companies listed in the NSE, we grew at some 28-29%, which was, I would say, a fantastic number which corporate India had after a long time. On that base, we are looking to see a moderate earnings growth in the year, given the basis high. So generally, equity returns tag the earnings performance. So when your earnings is moderating, so will be your equity expectations. So we are in a year where we are consolidating, is my view, which gives a chance to cherry pick your portfolio choices, moving away from weaker pockets to stronger pockets. I still think in this phase, it's similar to what we experienced between October 21 to March 23. Markets did nothing, but that was one of the best times to build your portfolio into good set of businesses and construct a fairly resilient medium-term portfolio. So use the correction or the consolidation to your advantage in realigning your asset allocation or your cap call choices based on your risk appetite.
Another question, probably it's a new gen, current kind of a question. AI particularly, and you're talking about GCCs. We may not have many listed players, or the impact of these businesses, at least currently, is not reflecting in our stock market or stocks so much. When do you think a large part of these evolutions will start impacting in listed stocks which may come into this space, and when is that likely to happen?
Little difficult to hazard a guess as to when we will start, because some of the easy ones, like in terms of customer care, data-driven setups are migrating to AI-driven setups. I think it's about the preparedness of a sector to embrace it and incorporate it as a part of their work SOPs. I think from our own market perspective, probably we lag some of the other developed markets by at least 3 to 5 years, depending on which sector we are looking at. Some of these, when we speak to experts or sectoral specialists, they are looking at it as an opportunity to actually drive efficiency. So there are two sets, right? One, whether it's impact your business. Second, whether you're able to make efficiency gains out of it. We are mostly hearing people who are looking at the efficiency gains coming into their pocket first, because we are still a growing market in terms of demographics. So not many are reading it as an outright negative impact when it comes to reading AI's prevalence in Indian context. When it comes, I think we're still 3 to 5 years away before we read a full-fledged impact into the way the business gets structured. I think that's the time which I would put a guess.
Great. I think we have given elaborate, clear answers for whatever. I think the queries which I was asking is mostly what an investor wanted to know. I'm sure viewers who are watching this would have had all detailed answers and clear answers to whatever are their questions in their mind today. Thank you so much for spending time. Thank you. It was great meeting and a great time together.